Welcome back, traders. Today I'm giving my thoughts and commentary on ICT's 2025 lecture series, specifically the video he put out yesterday called Making Money with SMC Concepts. Now, don't use this video as a summary. I'm just giving my interpretation, and I would encourage you to watch the original video, which I'll link in the description. Also, please give this video a like and subscribe for more videos like this, but let's go ahead and get into my thoughts and key takeaways.
Hello, folks. All right, so we're going to start a new lecture series here.
Okay, so first thing I've noticed, this is regular trading hours. You can tell by the bottom right, so this excludes overnight trading. Also, his chart is the NASDAQ micros. Usually he's on the minis, but on rare occasions he will pull up the micros. So I'm wondering if his 2025 lecture series will solely be on micros. That's what I trade, so I'll be happy to see if that is the case. And lastly, I can tell that this is also a real money account. On the bottom here, it says AMP Live. So instead of saying paper trading, this is rare because ICT has flashed live accounts before, but he's known as the paper trading guru. So I wonder if this will continue or will he switch to paper?
I don't want to really call it a mentorship, but I will hopefully provide you an example of an executable trading plan. It will be employed with a live real money account that's a regulated CFTC regulated broker. That means it's not market replay. That means it's not demo, it's not paper trading. And you do have to pay taxes on the income that you make off of it.
Okay, so it does sound like he'll be using real money for his lectures this year. Personally, I don't really care. I've never had an issue with him using a simulated account, but there are traders and influencers who do make a big stink about it. I'm sure they'll demand him to show more, like account numbers and trade executions or whatever, but personally, I don't really care.
So it's just to provide an example, okay? So that way it gives a real world, realistic approach on how to transition from demo and paper trading to then slowly rolling out the implementation of live risk with real money, okay?
Okay, so I see he's trying to show new traders how to transition from backtesting and paper trading to trading with real money. Now it makes sense why he's on the micros, because he's always been a big guy about controlling the risk. And I also definitely think you can reduce the amount of stress by risking a quote unquote small amount.
So by selling in on one market, and I'll be using predominantly the NASDAQ futures contract, I will be starting with a micro account.
Okay, so far in this video, he did mention having 5 tenets, and it sounds to me that the first one is to settle into one asset class, and he's going to be using the NASDAQ futures. Now, one of the reasons why I got into trading index futures is because there's less to look at. I only need to keep track of a few symbols. Back when I was trading stocks, I had to screen through hundreds of tickers, and every day it would be like a new ticker that was hot, and then it would fizzle off and I'll have to move on to a different ticker, while still keeping track of this one in case, it comes back later on. So now I can give all of my attention to just index futures and get to know its behavior pretty well. It's kind of like moving away from one night stands every week and actually cultivating a deep relationship. He goes on to say by using a smaller risk with micros allows you to hold on to trades longer, which definitely I want to learn how to do.
Central tenet number 2 is knowing how price tends to deliver based and by time.
Okay, so no surprise here. He always harps about how time is so important. By using the economic calendar and macros, you can time when price is likely to make moves.
Central tenet number 3 is understanding key pools of liquidity. Okay,
Yeah, so you hear me talk about liquidity all the time. Here he mentions how everyone knows about stops above highs and below lows. However, it's important to understand how price engages key pools of liquidity and why the market should draw there. And as a hook, he teases teaching something that's never been taught before, so I can't wait to hear what that is.
Central tenet number 4 is identifying inefficiencies in price. That means which ones really matter to me in this model.
Okay, great. Yeah, this is actually one of the hardest things for me to grasp is how to identify significant fair value gaps.
So that way it kind of helps you. And number five, finally, is utilizing simple points of entry and low hanging fruit price objectives for targets. And then simply wash, rinse, repeat. The benefit of having that information, it gives us the opening range gap. I'm going to talk about the opening range, which is the first 30 minutes of trading. I don't care what anybody else says, that's the only range the algorithm worries about. Then I'm going to teach you the first 60 minutes dealing range. Totally different. You're going to see losing trades. You're going to see me lose trades because I'm going to use rules and I'm going to place myself in situations like a new student that transitions from paper trading into live trading. You'll see it. You're going to see it in a broker statement.
Okay, so he just mentioned a bunch of concepts that he taught in his 2024 mentorship, and he's going to use it to build rules and put together a model and execute, simulating a brand new trader. Now, the important thing here is not to mimic him, but rather to see how the process is done. As you heard him say, he will have losing trades. This isn't even his normal trading model. He's just giving you a simple model as an example. Don't look at this as a shortcut to skip developing your own model or to skip backtesting. Those are still important. So still do that, just pay attention to his process and re-engineer it for your own purpose. Okay, so here he talks about starting with a frame of reference, which would be the opening range gap. The opening range gap is the gap between market close and market open for regular trading hours. You can easily switch to regular trading hours in TradingView by selecting RTH down here at the bottom right. And he also mentioned that if the gap is larger than 20 points, then you can go ahead and grade it with this gradient right here, marking out the 50%, 25%, and 75% levels. This is tenet number 4, identifying inefficiencies in price. The opening range gap is significant because all of this right here is void of buying and selling during regular trading hours. Now, he's looking for a price to trade back into the gap, specifically these levels. However, there's a really large gap, as you can see, so that tends for the morning session to first trade away from the gap. Then between 10 o'clock to 11 o'clock, he's looking for a change in the market structure that tells him we're going to be going back into the gap. And then as we go into the lunch hour for price to come back into the gap, he will be looking for a trade there. So tenet number 2, pay attention to the time. Also, he's not expecting this entire gap to get filled. He's targeting the low of the day right here. And that is going to be the low hanging fruit, tenet number 5. And then also he's looking at the 25% level as a high probability draw. Now price could go to the 50% level, but he's not going to require that. He's mainly focused on these two closest levels. Here on the 1 hour chart, you can see in the afternoon, price did come back down and hit the first two levels, but did not go to 50%. Now he's going to go ahead and switch over to electronic trading hours, so you won't see these overnight gaps anymore. So here on electronic trading hours, ICT is pointing out a premium level where price is reaching for. Tenet number 3, understanding key pools of liquidity. Now also note in my market outlook on Sunday, January 5th, I did also point out this exact high as my target for the week when price was still down over here. So make sure you have notifications turned on so you'll get my market outlooks as soon as they come out. After highlighting this 1 hour premium fair value gap, ICT goes into the lower time frame and explains why he was not looking for longs due to such a large opening range gap. Also, he does not want to initially look for any shorts because he wants to see how price will react within this SIBI, then look for algorithmic signatures indicating that price will deliver lower. On the 1 minute chart, the first signature appeared between 12:30 and 1 o'clock when price went back down to the lower half of the SIBI and refused to trade into the upper half. Now, know how the bodies are respecting the midpoint. So this gives him the start of a trade idea, but he doesn't just go in right away. Remember, tenet number 2, time. Here's the trade example he gives. He executed at 250, playing off of the 250 to 310 macro. Now for his exit, it looks like he was trying to see if price will go down to 50%, which will be that blue line, but it got stopped out on this wick right here. So probably set his stop loss somewhere up here and it just wicked him out. And yep, he does confirm that a little bit later on. Now he does outline the trade idea and his thoughts pretty well, but I do have one issue. He failed to address his risk on this trade. What I want to know is at what point does he consider this trade idea to be invalid, which he did not address.
With real risk. And going back to it, you might ask yourself, what would a trade like that require in terms of a stop loss? And I don't want Caleb to have more risk than what? 15 handles on this with a micro. So what is that?
Okay, never mind. He does address the risk later on, but it sounds like an arbitrary amount rather based off of structure. I would still like to know where exactly would this trade be considered invalid?
Let me ask you a question. If you were willing to risk $30, but you could make $90 or more, is that a reasonable risk to reward?
That depends on the probability of success. So if it's 50-50, then yeah, one trade you win 90, one trade you lose 30. So $60 over 2 trades, your expected value is winning $30 per trade. Now, if your probability of success is 25%, then you'll break even. And at that point, you'd be better off not taking the trade because then at least you don't have to incur fees and commissions. So it kind of all depends on the probability of success, not just solely the reward to risk ratio. Okay, so for the rest of the video, he goes on to talk about how you do want to aim for 3-to-1 or better, but it will take more experience. You would think that 1-to-1 is good, but he says that invites too many trade ideas that you could overtrade. He reiterates how this is a live account and how Caleb is the one actually executing. But that's pretty much it for this lecture. There will be 19 more coming this month. Don't forget to like and subscribe so you don't miss out on that, and I'll see you guys next time. Safe trading.